Hey everybody, Damien here, and today I'm going to show you a way that you can use stock options to generate consistent cash flow. I'm going to place a trade live while on video today, and I'm going to show you how you can take an initial investment of about $1,200 and turn it into about $50 a week in cash flow. I'm going to walk you through the exact steps that I use to place this trade and how I'm going to go about generating this weekly cash flow. So let's jump right in. The strategy that I'm going to be using today is called a synthetic covered call. Now, most of you are probably aware of normal covered calls where you own 100 shares of a stock and you sell a call option against those shares. The price of the stock goes above the strike price that you chose to sell your call option. So your shares would get called away. So you would sell your shares, hopefully for a profit at the strike price that you chose, and you'd collect premium that you sold those options for additional income. Covered calls are a great strategy that use options to create income. But what most people don't know is that you don't actually need to own 100 shares. What you can do instead is buy a long dated call option of a stock and have that call option mimic the 100 shares, thus creating you a synthetic covered call. So today what we're going to do is we're going to go into my broker, Tastyworks. There's a link in the description to them, and we're going to purchase a LEAP, a long expiration anticipation security. So a call option that's dated about a year out on ARK, ARKK. This is the investment firm ARK. This is their flagship innovation ETF. So this is an ETF that I'm bullish on, and I'm going to purchase a call option and use that call option that I buy to create monthly cash flow by selling calls against it. So let's jump into Tastyworks. I'm going to share my screen and show you exactly how I do this. All right, here you can see the chart for ARK Innovation. The ticker symbol is ARKK. And what I like to look at here, this is a 1-year daily chart. So you can see that ARK is down quite a bit from its highs a year ago. It was, around $70, $75, even higher than that before that. And it's currently sitting right around $38, $39. So it's come down a little bit from its recent high in February at about $45. This is a stock that I'm bullish on. It's a collection of stocks. They hold like Tesla, Zoom, Roku, Shopify, Coinbase, a lot of the big, like innovative tech names. And I drew this line here on the stock chart to show where the recent low was, right around $30. So just around like $29.30. And I wanted to find that out so I can know exactly where to put my strike price on my LEAP. So let's jump over to the trading screen on Tastyworks. We'll go here to trade, and we'll come out to January 19th, 2024. So that's when this call option will expire in 326 days. So if we go back to the chart here, you can see right around almost $30, a little below $30, but I'm pretty happy with $30. So we'll come back here to trade, and we'll come to the $30 strike price. So let me click on this. And what this option will do is it will act as 100 shares, right? So an option is a contract to purchase 100 shares. So we're going to pay about $12.50 per share to buy this contract. So this call option will cost us $1,200.50. If we get filled at the mid price, we might have to go higher to like 1255 or 1260 even and buy at the ask price. And I'll give you a quick introduction to some of the option Greeks. This is a 77 delta call. Delta is probably the most important factor in this call option. So that shows us how much this option will move relative to a move in the stock price. So for every dollar that ARK moves up or down, this option will move about 77 cents in that same direction. So in doing this, you want to be in the money for sure, because you want to lower the amount of extrinsic value that you are purchasing, right? Because we want to sell extrinsic value, but in this scenario, we are buying some extrinsic value. And we can find out exactly how much of this option price is intrinsic and how much is extrinsic. Let's just say for simplicity that the current price of ARK is $39. So that means $9 of this option price is intrinsic value. So it's already accounted for inside the options price, which means the rest of the options price is extrinsic value. So if we have $9 in intrinsic value, we have about $3.50 in extrinsic value. So about 75% of the price of the option that we're buying is already intrinsic value. So that's really just like buying the shares. But that extrinsic value, so the $3.50, that'll slowly decay over time. So that's theta, that's time decay, that's implied volatility, how much the market thinks that this stock price will go up or down until this option expires in January 2024. And that also will help us calculate our break even. So our break even on this trade, just for this call option, not taking into account the other call options that we're going to sell. So it's $30 plus $12.50 a share. So we're at $42.50 in 1 year. So as long as in 1 year, in January 19th, 2024, ARK is at least $42.50. This call option will be profitable. So that's not bad. I mean, we have quite a bit of time, and it was just there like 2 weeks ago. So I'm going to go ahead and buy this right now. I'm going to spend $12.55, a little bit over the mid price, to buy this long dated call option. And let's see if it gets filled. All right, we got filled. So the trade went through. So I now own one LEAP, a long expirated anticipated security on ARC. So what I'm going to do now is use that long call to create income by selling covered calls. So I'm going to come here to the March 3rd expiration date that expires this Friday in 4 days. It's Monday right now. And in Tastyworks, on the left side here, these are the calls. So these are the different strike prices that we could sell at. With the strategy, you really don't want to sell any call that has a strike price less than the strike price that you bought. So I bought the 30 call. So I'm definitely not going to sell anything that's in the money right now. So everything on the top side of this line is in the money. Everything south of this is out of the money. And I want to leave some potential upside for my call. So if the price of ARC increases, say to $40, then the value of my long call will go up. And I want to kind of try to guess, right, the best that I can, where this price of ARC will be in a week. So this Friday. So you can collect more income by selling calls that are closer to the money. So if I look here at 39 and a half, I can collect about $60, probably about $61 on this call if I sold this one. But what I would be doing is I would limit my upside to $39.50, right? So I would limit myself to about $75 in gains on the stock in the next week, but I would create $60 in income. So as long as the stock price stays below $39.50, I'm going to keep this entire 60 or so dollars, and I'll do this again next week. So as you can see, this is a strategy where you can really gain about, on this ticker, I'd say about 200 bucks a month. So if you do this 4 times, you're really at like 250 bucks a month. If you wanted to go further out, you could do this on a monthly basis. Say if I come to the end of March, it's one of the last days of February right now. If you sold like this same 39.50 call, you could get just over $200 for it. So $2.13 per share. There are some risks to this. So if ARC tanks, right, we lose money, but that's pretty obvious. Our long call would lose money, so we would keep this whole premium, but our core position would fall. And if ARC goes above $39.50, what would happen is we would probably either buy this call back if we want to keep our long dated call, or we would close both positions simultaneously. So we'd simultaneously buy this one back, probably for a loss. If the stock price goes over $39.50, however much it goes over, that's how much we would have to buy it back for, per share. So if the stock price is, say, $41, we would have to buy this back for $1.50 a share. But if the stock price is $40, we would, buy it back for 50 cents a share, and we would still keep, profit. And so I'm going to go ahead and place this order. I'm going to do it for $60. We'll see if this can get filled. So it's just a little bit above the current bid price, $59. So you can see right now I just put in a $60 bid to sell. So the ask price decreased to $60. So we'll see if this gets filled, and boom. All right, we just got filled. So now what we do is we wait till March 3rd and we see where this position stands, and we'll either possibly close them both, or we'll just buy this one back, or we'll just let this expire. That's our three options here. So that's how I plan to take $1,250 initial investment and turn it into weekly recurring cash flow. So just to summarize, I bought one long dated call, so expiring in 2024, for $1,260. So that was my initial cost. I'm going to sell a covered call every week against that call that I bought. And this week I collected $60. So you can see if you repeat this step every month, just selling slightly out of the money calls, assuming that ARC at least maintains the current price it is now, you should be able to generate about $240, $250 a month. There are some obvious downsides to this. If the stock price tanks, being the worst is that the value of your long call that you have will slowly degrade and you'll lose money. And the price of the short calls that you sell every week will also go down. So you collect less premium each week and have less weekly income. But either way, this is a great strategy for those of you who want to get into covered call writing, but don't have enough money to purchase 100 shares of this stock itself. So 100 shares would cost you about $3,800, $3,900. And right now we're doing a very similar strategy that produces almost the same amount of weekly income using only $1,260. So you can see here the ROI is a lot higher. So thanks for watching, everyone. I'll film another video next week about what I do once this call that I sold has expired, and show you how I continue this trade to continue bringing in that weekly income.